Fantastic. So look, obviously you've been in the market a long time, and you've seen lots of trends and things change. So let's maybe take back to going back to sort of like, if I'm a novice trader, if I'm brand new to trading, what advice would you give to someone that's sort of new to trading? And then when we'll come on and talk about that afterwards, around sort of looking at different markets and how different markets work. But what if someone was telling a young David Morrison now you're going to start on the trading floor, what advice would you give to yourself when you're starting that journey?
Go in with your eyes open. Don't expect to get rich overnight. If you really need to make money trading, then you probably won't, because you'll probably be forced or panicked into making the wrong decisions. So it comes back to sort of you have to be honest with yourself, and then you have to have an interest in markets. And then you have to really do a bit of work around those markets, quite a bit really, understanding charts, understanding how they work, understanding what particular technical indicators might mean. I mean, it's one thing to say, "Oh, I tell you what, I've got a chart here of such and such, and I'll put I don't know, a MACD on it, or a Bollinger Bands, or a Fibonacci retracement." But you've actually got to understand what that's telling you. And I mean, that's a really big, important thing. So it is, I'm going to say I went into it when I was much younger thinking this is going to be an easy way to make money. And for 2 months it was, and then suddenly it wasn't. And, and yet I hadn't got all these things in place. I hadn't thought about them, and I certainly didn't have a trading plan. So there are all those different aspects to it, which I said are kind of fundamental to success. Before you get started, before you even make a trade, really.
And I guess that's one of the things that people come in and go, okay, there's probably a question around. They might say, well, which market do I focus on? Or I guess there's so many different options. You've got 1,500 to choose from. I guess that's part of the challenge for people, isn't it? Because they see this opportunity, they see maybe people are making money. There's a lot of people out there, but reality is, in most cases, that it's not quite, like you said, it's not quite as easy as that, isn't there? And there are probably some maybe common mistakes. What are the common mistakes that you see traders making when they're trying to sort of look at charts or look at data or try and beat the markets, as it were? What are some of those common mistakes you see them make? You'd encourage someone watching this to take note of.
Mistakes. There's some very obvious ones.
There's lots of the buzz sounds things, but
yeah. But I'll just sort of focus on a couple maybe, and that is, it's very tempting if you sort of put a trade on in the market and the market doesn't go your way. It's very tempting to double up and sort of like buy in at a lower price and bring your average down, or sell another position at a higher price and bring your and have your average go up. But what you are doing is perhaps compounding a trade, doubling up on a trade which isn't working for you. So I think the most important lesson that I learned is that if a market isn't doing what you expected it to do, obviously, if you've got your stop in place, you keep your stop in place and you don't move it. That's another one. But so don't be tempted to move your stops, to give yourself a bit more leeway, at least not until you really have a better understanding of markets. Don't double up on positions. And I think the most important thing is, if things are going wrong, then close out the position. If you're unhappy, if it's making you feel nervy or whatever, cut the position, just forget about it and start again. And I don't mean rush in to take another position somewhere else. Take a bit of a pause, take a step back, try and understand what went wrong with that, what you got wrong in your thinking, because every trade is really a test of your analysis of the markets. And that's what you're doing. You're saying, I think the market's going to do this, this, and this because of this reason. You put your trade on. If it doesn't work out, things don't work out all the time. So cut it. I think that's like the Rod Stewart song, isn't it? The first cut is the deepest. Although it's not that, is it? Anyway, is it the first cut is the cheapest? Is what he should be saying.
There's lots of market information. There's lots of data. We watch the news every day. There's so many different types of, if you're a trader in the current market environment, one of the things that could happen to you is overwhelm, right? Because there's lots of information, lots of data from different sources. Now, how important is it for people to stay aware of some of those sort of macro, major political events like obviously, of course, the wars in different countries, sadly, are massive factors for that. And, you've then got big economic changes and drivers. If you're a trader and you're relatively new to trading, how in tune with that sort of stuff should you be? Because obviously you've got so much things to cope with. There's so much information to take on board, isn't it? And how do you let that affect your plans, I guess, is my question.
It's a really tricky one, because it's so tempting to feel that fundamentals are the big drivers of what's happening in the market. And to some extent they are. I mean, if you've got central banks sort of like pouring in, huge amounts of monetary stimulus, and governments sort of pouring in huge amounts of fiscal stimulus into a market, then that's a fundamental factor that's going to push asset prices up. But at the same time, technical analysis is extremely important too. And sometimes a fundamental event, a piece of economic data, a change in what the central banks are doing, yes, they can move markets quite dramatically, but sometimes it won't break out. It won't actually affect the trend of what the market's doing in any case. A market could be trending upwards. A central bank does something like increase interest rates. You see a dip in the market, but then that gets bought, and the upward trend continues. There are things like that. That's perhaps I don't know, a good example, a bad example, I don't know. But what I'm saying is that fundamentals do affect markets. What I would question is whether they affect them over the long term. Some will, like what central banks are doing with their monetary policy. Others won't, whether it's a piece of non-farm payroll data which comes out way out of expectation. It could move markets for a day or two, and then it's discounted. And so it's a difficult one to manage, really.
Maybe an idea could be for traders just to maybe put some small amount of time aside per day, maybe 15 minutes or so in a diary, put some time in the diary, have a look at some other key resources for the news. Keep aware of it, but don't necessarily let it affect their actual plan. Would that be potentially worthwhile?
I mean, I think it's very important to look at the economic data calendar and be aware of what's coming out and when. It's just something that you ought to do, because, I mean, otherwise you're going to see, especially if you've got open positions, you're going to see markets swinging around and you'll have no idea why that might be. And is that movement important or is it not? Now, that can be a judgment matter, which you sort of learn over time with experience. But, markets are constantly surprising you. Constantly.
Yeah, well, that's why people stay in it for so long, right? Because it's every day's different.